Welcome back, everyone. We have a ton to get into today. First of all, a little portfolio update. I just made 2 purchases this morning, $2,000 worth of stock. I'm going to be going over which companies I'm buying and the reasons why. We also have some pretty big news from Barrons. It's not often that the business journal Barrons makes such a bold call, but that's what they did this week. They say it's time to stop crying about bonds and buy them instead. And this is a call where they're really not holding back. They're saying it's time to start buying bonds, and they lay out their investment thesis for bonds right now. Now, they're not the only one making this call. Another big-time investor, Howard Marks, who is a billionaire, a hedge fund manager, he founded Oaktree, he's urging a significant allocation to the credit market. He's again saying it's finally time to buy bonds. He said this in interviews, he said it in his Howard Marks memo. So we're going to be going over this argument. We'll be looking at bonds. Is it time to finally start buying bonds? Now, we have a lot of business news to go over. McDonald's just reported earnings. It's up over 2% on the day. It beat its estimates with a substantial 14% revenue growth. McDonald's is killing it right now. We have other companies that are having a more tough time. Tesla's having a rocky second half to the year. It's trading down nearly 4% today. And other companies that have a similar trait are also trading down as well. Sunrun is down big time this year. These companies are struggling, and I want to go over what I believe is the continued struggle of these type of companies. Another company that's struggling is Realty Income Corp. This is a dividend investor's favorite, the monthly dividend company. It's down big time this year, and it's down 7% on the day because of its announced acquisition of Spirit Realty Capital. This is another diversified real estate company that Realty Income Corp is now buying. We'll be looking at the details of this deal and seeing if it's such a bad deal. We have an update on Disney, specifically that the activist investor, the billionaire Nelson Peltz, is now pushing for Disney board seats, and he's being boosted by someone named Perlmutter. So this is a pretty big development. This activist investor no longer is working alone. He has a huge ally to help him, and this may shape the future of Disney in a different way. So I'll be looking further into what this means. Now, we also have another interview to go over, this time with Jeremy Siegel, where he lays out the case of why he still remains bullish on this market. And he believes the market may have a really good rally by the end of this year. So I'll be looking at the case that he makes. And then finally, we have something here I just have to highlight because of how ridiculously funny this is and absurd it is. There's a group of people that have bought into the meme stock Bed Bath & Beyond. Bed Bath & Beyond has gone bankrupt, meaning that the company no longer exists in terms of an investment. There is no equity. The stock price is at zero. Investors own nothing. They own no equity, no value in Bed Bath & Beyond. Now, there's some investors that are perplexed and confused of why Fidelity has delisted Bed Bath & Beyond and removed the shares. And they're yelling at Fidelity's X account saying that the company is acting inappropriately. Fidelity, on the other hand, is trying to explain what it means when a company goes bankrupt. The situation is hilarious, the responses are hilarious, and we'll be going over it in this episode. So we have a lot to get to in this episode. Let's go ahead and start off with a quick portfolio update. The passive income portfolio is my main investment account. This is where I have the majority of my invested capital, and I add to it every single month. So I'm always adding more and more to this portfolio, trying to grow it. The portfolio is concentrated into a group of high-quality companies that I consider to be compounders, meaning that no company in this portfolio is speculative. None of them are maybes. Every single company that I'm investing in, I consider to be highly predictable. The future, in my opinion, is almost near certain. These highly predictable companies also typically have high barriers to entry. They have incredibly strong balance sheets. They have business models where they have pricing power, brand recognition. They can continually raise prices year over year over year. And even though customers may not like the price increases, they'll continue to pay it because of how good these products are, how powerful these companies are, and how difficult they are to compete with. I make concentrated investments into these companies, and I add to them at any opportune time that I can. Now, over the past couple of weeks, we've had earnings season. Most of my companies have reported earnings, and one of these companies, I believe, has sold off unfairly. That one is MasterCard. I was in the green by around $4,000 with MasterCard, and then it sold down. It sold down to where I'm only in the green by $800. And so this is one where I've actually invested another $1,000 into this company as it's traded down. Look at it right here. It had momentum, it was growing this year, and then over the past month, it went down quite a bit. It's down around 10%. Now, MasterCard's earnings report got punished. The stock traded down 4% after its earnings report. But when I looked through MasterCard's earnings report, I couldn't find anything wrong. In fact, the company's growing like a weed. Third quarter net revenues up 14%. Third quarter gross dollar volume up 11%. Top and bottom line are growing of this company. The profits are growing. Now, if we go down to the cash flow statement, I did notice one weakness. For the first 9 months of the year, the cash flow provided by operating activities has decreased from just over $8 billion to just under $8 billion. So by a couple $100 million, the cash flow has gone down year over year. And I was wondering, why is the cash flow going down even though the company is growing revenues like crazy year over year? And what I could see right here is the litigation and legal settlements increased by around $400 million year over year. So they had a lawsuit that caused them to lose around $400 million this year. I looked up the lawsuit and they're saying it's basically an antitrust fee. They're saying that MasterCard charged merchants too much to use their interchange. So MasterCard was fined a couple $100 million from the government. Other than one-time litigation fees, MasterCard continues right along its long-term growth trajectory. Look at the latest quarter there. It's right in line with where it's always been. And even with the latest quarter in cash flows, it really doesn't look too bad. Look at this cash flow over time. That certainly doesn't look like a bad trend to me. Keep in mind that MasterCard is not a credit card company. It's not a lender. It is a digital company that connects different parties together, and it should be looked at as a high-tech company. A big portion of this company is also value-add services. It does a lot more than just payment processing. So this is a high-quality tech company that I'm continuing to add to. I just bought another $1,000 of it this morning. The other company that I continue to add to is Intuit. This is one that I really like the positioning of Intuit. I think the bears have this one wrong. The bear case for Intuit is pretty simple. People believe that the company has relied on acquisitions to mask its slowing growth in its core products. I don't believe that's the case at all. I believe that small businesses, for the most part, are doing really well in the US, and they'll continue to do well over time. Intuit has a virtual monopoly on small business software. Intuit's growth has been incredible. Looking on it on an annual basis, there's really not a lot of companies like it. It has skyrocketed since 2017. Intuit's following the footsteps of Microsoft and Adobe by making this transition from desktop one-time pay software to cloud-based subscription model. And they are well underway with that transition. Now they have around 80% of their total revenue from cloud, from subscription model. That is an incredible endeavor that they've accomplished. They can increase pricing power dramatically with this new business model. So my buys this week are simple. I bought $1,000 more of Intuit and MasterCard. I share this to have some level of transparency. And if you want to see more buys from me in the future, make sure you subscribe to the channel. I'll continue to be transparent. Now, moving on from my portfolio, we have this big news of the week. Barrons doesn't frequently make this big of a call. The company once in a while will say these are stocks they're bullish on or these are stocks they're bearish on, but this is a pretty big call that they're not holding back on. They said it's time to stop crying about bonds and buy them instead. Rarely in American history has it been this bad for bonds, and rarely has it been such an opportunity to buy bonds. Supposedly, ultra-safe treasuries are on track to lose money for 3 consecutive years, declining 42% over that period. Now, this is there's a caveat here. When people say that treasury bonds are ultra safe, they're meaning that you're going to get paid back by the US government. Keep in mind that a treasury bond is a contract with the government. You're buying their debt and they're going to pay you a certain amount of interest every single year until the entire amount of the debt is paid back over that time horizon. So you get your entire principal amount plus interest back from the government. But that doesn't mean that the investment overall is safe. Duration risk means that as bonds go up and down in value, the immediate value of your bond may drop if the yields go further up, which is exactly what's happened to a lot of different companies holding these bonds. In fact, that duration risk was the very thing that got Silicon Valley Bank bankrupt. It was the one thing that tanked the company. So yes, the government will pay you back, technically speaking. The money may be worth a lot less because of inflation, and you always have the ever-changing immediate price because of all the duration risk. So I would not refer to treasury bonds as all around being a safe investment. Investors still stand to lose a lot of money in these investments. What they're highlighting here is true. The decline has been substantial over the past couple of years. Treasury bonds are down 42% in value. Other bonds, whether mortgage-backed securities or high-quality corporates, have also taken a beating, leaving investors with losses from what are supposed to provide ballast in their portfolio. But consider what may happen next, the end of the bond bear market. While the long-term yields have spiked lately, pushing the 10-year Treasury up to 4.9%, the Federal Reserve may be nearing the end of its campaign of interest rate increases. Traders see only a 25% chance of another rate hike this year, possibly at the Fed's meeting in December. Hedge fund manager Bill Ackman, a prominent bond bear, recently closed his bets against Treasuries. So that was another big thing. Bill Ackman said that he's no longer betting against the US Treasury. So him stepping out of that, I actually believe influenced the market overall, and it does have an impact on investor sentiment. He closed his hedge because he thinks bonds may be at the top. Barrons continues on with their bull case for bonds today, saying that it starts with the fact that today's entry point is the best in years. Yields across treasury markets are around 5%. They are the highest since 2007. Investment-grade corporate bonds pay on average 6.3%, a yield not seen since the mid-2009. If you have bonds go back down in yields, yours are relatively more valuable. So investors may pay a little bit more for that yield. It isn't just the long-term bonds that would benefit. Once the Fed does pause, the stage could be set for strong returns across the curve. According to JP Morgan's fixed income strategies, over the past 8 Fed tightening cycles, bond yields were down by a full percentage points on average after the final hike. That happened irrespective of whether a recession or soft landing followed. So the setup right now does seem optimal to own bonds. And so far, when I read through Barron's case for this, I think they make a very solid case. I don't see a lot of weakness with their arguments here. It does seem like, at least in terms of the past 10 years, right now is the best time to start buying bonds. Howard Marks is also making the same case in a little bit different of a way. Now, the next thing that Howard Marks says is something that I really think a lot of people are not going to like hearing. A lot of investors are going to argue with this. A lot of you are going to be upset, but it needs to be said anyways. For the past 10 to 15 years, we have been in an ultra low interest rate environment. And he says, quote, "For a number of reasons, ultra low or declining interest rates are unlikely to be the norm in the decade ahead. So the future does not look like the past. Quote, if this really is a sea change, meaning the investment environment has been fundamentally altered, you shouldn't assume the investment strategies that have served you best since 2009 will do so in the years ahead." So again, he's emphasizing this point that what's worked previously may not work in the future the same way. Howard Marks is saying that companies that have thrived with low interest rates are not going to thrive in the future. And we look at a company like Tesla. This is one where consumers rely on financing to buy their products. The interest rate that loan has determines in large part what your monthly payment is for the Tesla vehicle. As interest rates go up, Teslas become more expensive, meaning that Elon Musk is forced to lower prices for the vehicles to match consumers' buying power. If we look at some of the ratios of Tesla, we can look at the operating margin of the company over the past 10 years. Notice that during a time period of ultra low interest rates and lots of stimulus, the company had really high operating margins, reaching up to almost 20%. This is much higher than a traditional car company. But what we see is over the past 7 or 8 quarters, a continual decline in operating margin as the company is lowering prices over and over and over again for their vehicles. They have to compensate for the rising interest rates and the impact that has on consumers' buying power. Other industries that at one point had incredibly good business models during low interest rates are now being obliterated, Enphase Energy being one of them. If we zoom out on Enphase's stock price, it shares a story here. During a time period of ultra low interest rates, the stock price rose exponentially, going from a few dollars to up to $300 per share. Enphase was considered to be unstoppable. But this product, solar, is very similar to cars in that it requires financing. To buy an array of solar panels for your roof, in some cases that can cost around $20,000 if you're buying it at a low interest rate. Let's say 3 to 4%. Now interest rates have over doubled. Now the consumer may have to pay double the amount to cover the same amount of wattage. The problem is, in a lot of cases, that doesn't save the consumer from using the grid. and that's the primary purpose of solar panels. The decline in Enphase's stock price has corresponded with the increase in consumer financing costs for solar panels. So when Howard Marks says you shouldn't assume the investment strategies that have served you best since 2009 will do the same in the years ahead, he's speaking specifically about this type of stuff, that certain companies are impacted in different ways with the rise of interest rates. The environment has changed, and that's what he terms the sea change. And he argues strongly, just like Barrons did, that it's now time to look at credit investments. It's now time to look at bonds. Now, after reading this from Howard Marks, I believe he makes a very good case. I think it's very convincing, and he brings up a lot of good points. And I believe the same from Barrons. They have a very good argument that now may be a good time, an attractive entry point for buying bonds. And I don't doubt that investors that buy bonds right now will have a decent return. But as far as I'm concerned, I'm not going to be buying bonds. And I believe part of the reason that I've come to this conclusion personally is because I believe an important part of portfolio management is sticking to your plan. A couple years ago, I outlined a portfolio management plan. In fact, I put structure to it. I went over position sizing, my buying and selling. I went over the specific attributes I'm looking for in companies. I've leaned directly into companies that are world-class tech companies, that have incredibly strong balance sheets, that have ample growth opportunity and pricing power. And I believe I'll have a better outcome for my portfolio by sticking to my already well-constructed plan with discipline than changing it on a whim because of the arguments of Howard Marks or Barrons. Although bonds may be attractive right now, I believe the companies that I already own are incredibly attractive, and I think they're going to beat out the returns of bonds over the next 5 years. So as far as I'm concerned, I'm sticking to my plan, but I don't blame people for buying bonds right now. I do think they're attractive. Now moving on, one company that's struggling today that's one of the dividend investors' favorites is Realty Income Corp. The reason that dividend investors love this company is because it pays a monthly dividend, so you have something to look forward to every month. And the company has a really good history. It's outperformed the market for a long period of time. They were one of the early ones that got into the REIT business, that bought up a lot of key real estate. They had great partners that they owned the real estate of. So this has been a great performer, but more recently, it struggled. Today, it's down over 6% on the announcement that they're buying a company called Spirit Realty Capital for a $9.3 billion transaction. Spirit Realty Capital is up 7% on the same news. And this is exactly what I would expect. Almost every time the company being acquired goes up and the company acquiring the asset goes down. Why does that happen? Because whenever a company like Realty Income Corp purchases another company, they have to do so at a premium. The investors that own this company want to get a good deal on this sale. And typically the one buying it, paying a premium, gets adjusted downward a little bit for this transaction. I think with companies like Realty Income Corp or Vici, patience is a virtue. It's going to take time to get out of this uncertain environment in terms of interest rates back to a more stable environment. But once we get to that topping of interest rates or flattening of interest rates, I believe these companies will have a little bit better reaction from the market. Right now, investors want nothing to do with them, so you're seeing them be liquidated. Now, moving on, we have McDonald's reporting their earnings today. And this is an example of a company that's not struggling at all. I've had a very bullish stance overall on this entire industry. The industry of quick service restaurants and sit-down restaurants like Texas Roadhouse. I think people are too addicted to the convenience of fast food. They're too addicted to the experience of just driving through, getting your food, and getting along with your day. Most people aren't going to create homemade meals every single day in their kitchen. And with how busy people are, I think that that's unlikely to return in the future. So I see this secular trend of restaurants like McDonald's becoming more and more important in the future. Now, McDonald's is not my bet in particular. I'm not invested in this company, but I do have investments in Chipotle and Texas Roadhouse. One thing that I noticed was interesting about McDonald's earnings report. The company reported earnings per share that beat estimates, so that was good, $3.19 versus $3 expected. They reported revenue that also beat estimates. That looks really good, top and bottom line beat. Now, all of that looks good, but we get into what I consider to be a weakness from McDonald's report. And I don't think investors are focused on this too much right now, but I do consider this a weakness that's worth looking at. They say that the price hikes have offset falling traffic in its US locations. So basically, McDonald's is seeing a decrease in customer traffic, but because they're increasing prices so much, it more than makes up for it in revenue. That traffic drop-off was the only weakness I saw with McDonald's report. Other than that, I thought overall it was a very strong report. Now moving on, we have some breaking news that's highly important for the Disney shareholder. Nelson Peltz is an activist investor that's been openly critical, vocally critical of the Disney executive management. He's also trying to influence Disney for the better. He wants to have multiple board seats on Disney's board to have greater control over the future of the company. Now, this has been a battle because so far Disney has been incredibly resistant to Nelson Peltz having anything to do with Disney. And they've gone back and forth in press releases, pointing out how the other one is basically dumb and they don't know what they're talking about. They've pointed out that Nelson Peltz doesn't know what he's talking about with media. Nelson Peltz has pointed out that the Disney executives are paying themselves a fortune for underperformance. And the big news today is that Nelson Peltz now has a leg up in this battle. That leg up was afforded to him by someone named Perlmutter. Perlmutter is putting all of his support and his shares behind Nelson Peltz's effort. Now, I'll go into who Perlmutter is in a minute, but I want to preface what's really going on here and the big core arguments that I think people are getting wrong. The first thing that I think people get wrong is a lot of people defending Disney say that Nelson Peltz really can't help Disney out because he's not a media expert. He doesn't know anything about the media industry, so why would Disney want him on his board? Well, let me remind you, according to Disney, they're the media experts. They really know what they're doing. Here's what the Disney media experts and the geniuses at Disney have returned to the shareholder over the past decade. 10 years and they've given 17% returns. So Nelson Peltz is being criticized for not being the expert, and we're supposed to believe that Bob Iger is the expert? This is his returns. He owns this. The only time period that he blames someone else for is during Bob Chapek's tenure, who is someone who he handpicked as his successor, who he sabotaged him the entire time he was his successor. And then he came back, fired him in the dead of night, and resumed control of Disney, which has subsequently fallen further and further in price. Look at the job the experts have done. They're not creating any value for the Disney shareholder. And the people saying that he's not an expert in this are entirely missing the point. The point of Nelson Peltz getting on Disney's board is for accountability, to have a strong, critical voice that holds the executives accountable to the shareholders. Right now, Bob Iger has paid himself millions and millions and millions of dollars. He's one of the highest paid executives ever for accomplishing a 17% return on Disney in the past decade. And Nelson Peltz is representing the shareholders and saying that this should not be the case. So the whole purpose of Nelson Peltz obtaining board member seats is not because he's some media genius, but because it will have a strong critical voice to the Disney management that have been rewarding themselves, overspending, mismanaging without any accountability. What Nelson Peltz represents is accountability to the executives from the shareholders. And because of that, I have fully supported him obtaining greater control of this company. Now in comes this new guy named Ike Perlmutter. I didn't know about him previously, but apparently he was a previous senior executive at Marvel Studios. So he's someone that does actually know the industry. He worked in it. And he's now putting all of his shares, which he owns a substantial stake in Disney, he's putting that behind Nelson Peltz's efforts. And he's now vocally supporting Nelson Peltz. He says right here that while I was a Disney employee, I was not comfortable publicly stating my views on the company and its performance. As someone with a large economic interest in Disney's success, I can no longer watch the business underachieve its great potential. This gives a greater chance of success to Nelson Peltz obtaining board seats and having greater influence on the future of the company, which is a positive thing. As good as Bob Iger may be at making some deals and acquiring different properties, this type of return over a 10-year period should be looked at with strong criticism. Most CEOs would be fired, they would step down, they would be embarrassed by this return. But Bob Iger still looks at himself as a brilliant CEO while giving these type of abysmal returns. So hopefully Nelson Peltz is victorious. Now moving on, this second half of this year so far has been really rocky. We were off to a great start. 2023 seemed like it was going to be really easy, but then as we can see with the S&P 500, over the past 3 months, things have sold down quite a bit. There's one investor that remains incredibly bullish on the end of this year. His name's Jeremy Siegel, and he explains here why he remains bullish.
We're 10% off the low. We just entered correction territory for the S&P. We did it a few days earlier for NASDAQ. We're 15% off of that October low of last year. And I went back 50 years, and if that October low holds, which I very strongly believe that it will, returns in the market over the next 1, 2, 5, 10 years are very, very good. In other words, if you can invest 15% off of a bear market low, which is what we had a year ago, your subsequent returns have exceeded the market by quite a margin.
The number that he's saying is important to hold is that October low of last year. If we hold that, according to the past 50 years, the trends are that we'll have very good returns. Now, he goes on saying another thing that he believes is a catalyst, and this fits right along with what Barrons said, what Bill Ackman did, taking his hedge off, and what Howard Marks is saying. Now we have Jeremy Siegel basically saying the exact same thing.
I think we're pretty well near the top on the 10-year, maybe 5.25, but we're not getting up into those levels. And that's the only time that we really saw anything that was like single-digit PE ratios. Exclude that period of time in year 17, 18, 19, 20. So I think valuation is persuasive. I actually think growth is going to be better next year. And I, in fact, think that the higher real interest rates that we've seen is actually more optimism about growth in 2024. And that's going to pressure, the stock market because it has to discount those higher earnings. But I think those higher earnings are going to come through.
He believes, like the rest of them, that we're close to the top of the 10-year treasury. And he also believes that we're going to have strong earnings reports next year, which is another thing that I fully agree with. So I agree with Jeremy Siegel. There's no way to guarantee the market will go up, but so far all the data points look very promising. Now moving on, we get to a subject that I think is both sad and hilarious. I had to highlight this because of how ridiculous it is. There are people right now on X, previously Twitter, that are upset that Fidelity has made their shares disappear. Fidelity, the brokerage, has removed their shares of a certain stock. That stock is Bed Bath & Beyond. Now, if we bring up Bed Bath & Beyond to observe its fundamentals in Qualtrim, you can see that it's not really moving today, and the share price is down to 8 pennies. That's because that's the last recorded price after the stock was delisted from the NASDAQ. It was taken off of the exchange because it's now a worthless stock. The company went to zero. The market cap is zero. The PE ratio is not applicable. There's no price to sales because there's no sales. No EV to EBITDA, no price to book. When you look at the fundamentals, they're in deterioration for a long period of time on a strong downward trend. The stock price was also trending downward into penny stock category. And ultimately, the company had too much leverage. It couldn't pay on its loans, declared bankruptcy, was delisted, and it no longer offers any value to the investor. This is essentially an example of how you can lose 100% of your investment. A stock can go all the way to zero if it has leverage and if its business fails. So this is simply put an investment, a meme stock that went to zero. Nothing too unexpected. Now these people online, on X, they're angry that Fidelity had the audacity to remove their shares of a company that has no value, that there's no shares because the company, it doesn't exist anymore. Fidelity has been responding to these people hilariously, one at a time, explaining what it means for a company to go bankrupt. At this time, the shares of Bed Bath & Beyond have been delisted, as the security has been deemed to have no stockholder equity. It is now considered worthless. There will be no future distributions, and the position was removed from shareholders' accounts on October 18th, 2023. They're nicely explaining that it's not anything anymore. It's not worth anything. There's no reason to have it in your accounts. But there's still more people very upset about this one. This user Phenomenon says, "What do you mean expired? How can shares held in cash accounts expire? Can you please explain what is going on with Bed Bath & Beyond to the masses? They say otherwise thousands of complaints will be logged with the SEC right before the end of the month." This user is angry at Fidelity, threatening to log complaints with the SEC if they don't respond. Fidelity once again explains with the same message that the company has no value, so it was removed. And then this user continues on, berating Fidelity, saying they can just declare shares worthless and poof them in a cash account. Fidelity is about to have one of the biggest withdrawals ever. I thought South Park was a parody. And then they tag the SEC asking if it's legal. We didn't sign and they can't just remove our shares without replacement distributions. It's like it hasn't dawned on some people that when a company goes bankrupt, it's not magically going to resurface from the dead. A lot of people are having a difficult time coming to terms with reality that their equity in this company is gone. So if you ever think that you can't outperform the market because the average investor can't, keep in mind that the average investor includes people like that. That's all for this episode. Hope you enjoyed, and I'll see you in the next one.